Hey Alexa, can I have a recipe for spaghetti?
There's no time to make spaghetti. The seminar is about to start.
Hello everyone. We're now live and recording. Welcome everybody to session 3 of our series. If you have been coming to our other series, welcome back. We hope you have learned something that will allow you to think and to stay rich. If this is your first Tuesday afternoon networking, I'm just as happy for you. You are joining us at a perfect time. Hi, my name is Coco Tan. I'm a realtor at Keller Williams Realty in the San Francisco Bay Area. But more importantly, I'm excited because it's holiday season, and that means family and feasts and wine and vacation time. What better way to kick it off than by seeing you here for another special session of Tuesday afternoon networking. If you are not already subscribed, scan my YouTube QR code here. And while you're at it, scan my WeChat and WhatsApp code here to connect. People in my WeChat group get special access to off-market home information. Just put a note with your request saying that you want to be added to the real estate live stream group. I'm about to hit the maximum of 500 people, so I will start a second group. Is everybody ready now? Okay, let's begin. If you have seen our email advertisement or our YouTube teaser, you know that today we're discussing the mysterious, enigmatic law known as by its full name as California Proposition 19, Property Tax Transfers, Exemptions, and Revenue for Wildfire Agencies and Counties Amendment. But that name does not fit on a DMV form, so we'll just use its nickname, Prop 19. Prop 19 was on the ballot this November, and it narrowly passed. So the question is, now what? In the previous sessions, many of you have asked how Prop 19 affects us as homeowners, especially in relation to estate planning. And the answer is, it's complicated. The law affects not only estate planning, it also affects people who are planning to relocate within the state, people who are over 55 years old and planning to buy a more expensive home and wish to transfer their property tax base. If all this were simple and easy to explain, I would have done so already. But for a topic like this, the best thing to do is to invite an expert who has lectured on this many times to many different groups. The expert is Michael Lee. Michael is the managing partner of Ray Attorneys, a premier Bay Area law firm specializing in estate and tax planning. His practice structures international business transactions and provides wealth management services for high net worth clients. His clients include multinational companies, directors, and fiduciaries. Michael is so passionate about this topic that he calls his presentation, Act Now or Forever Hold Your Peace. Please welcome Mr. Michael Lee. Hi, Michael.
Greetings, Coco. Thank you very much for the kind introduction, and I am equally excited. This is one of the last seminars for me for the whole year because we go into the Christmas and Hanukkah season. So I'm very excited to be with all of you because some things have changed in California law. We had the California election and Proposition 19 passed, which we're going to talk about. We're going to talk about sort of the good, the bad, and the different for Proposition 19. So we're going to talk about those things. And very important, what we talked about also is a little bit about estate planning, because much of the Proposition 19, how it actually works, how you're going to encounter it, either older Americans moving to another property, or through your own estate planning, you're generally going to see Proposition 19 in something like that. Generally, you're not going to see Proposition 19 elsewhere out in the wild. So what I think I will do is I will share my screen and add my slides, and then we'll start taking a look at the slides, and that can organize our discussion here, which we'll do right now. So let me add this all for you. Great. So what I have for you, Proposition 19 and estate planning. So this is what we're going to talk about right here. So a little bit of introduction about me. Who am I? And sorry about that, my webcam fell down there. So who am I? And what are we talking about here? So I'm Michael Lee. I'm a founding partner of RUI Attorneys, and we practice estate planning and business planning in the Silicon Valley. I've had a number of roles throughout my career. I've worked with the Chief Counsel's Office of the IRS. I've worked with the U.S. Attorney's Office. I was a clerk for the U.S. District Court. So I've done yes, my fair share of rotations in the law realm. And then now I'm back to where I like to be in private practice, working with all of you. And then, of course, I have my partner, Xiaowei Li, and Xiaowei Li is my fellow attorney in the office, and she handles a substantial amount of work with Chinese-speaking clients, and she does a lot of estate planning, conservatorship planning, guardianship planning for domestic and international persons. So that's a little bit about us. We're lawyers, but we're the good lawyers. We're the friendly kind of lawyers. We try to solve problems. And by solving problems and working with people to solve problems, some of our work is doing what we're doing today, telling you about what the law is so you can make good decisions with your real estate agents and brokers, your accountants, and your lawyers. So what are we going to just talk about? Just to give you an introduction, like I said before we jump into the Proposition 19 stuff and get into that, we'll talk about just a little bit about estate planning in general. So basically what we're talking about for California is that if you don't have an estate plan, if you don't do a revocable living trust and do that type of estate planning, you may end up with probate. And probate is the transfer where the court moves your property from one generation to the next, rather than going through an orderly process. Again, you think, oh wait, I was here for Proposition 19, why are we talking about this? Well, there's a classic Proposition 19 problem. If you don't do estate planning, you may not match the way Proposition 19 wants you to move your property. There are now restrictions on whether or not the heirs can keep their property tax basis. The other thing that estate planning does, which you have to think about, I have a lot of clients, they think, they see me for their own work, and I say, okay, great, we've got everything established for you. You're in your 30s, maybe you're in your 40s, young children. I say, well, your parents have done this, right? And then I'll say, oh, no, I actually didn't think about that at all. They haven't done anything. And there's a classic problem and an opportunity that we have under the new Proposition 19 of maybe they need to downsize. Maybe it's time for them to sell that property. And then a lot of people say, oh, no, because when they buy their new home, they're going to be reassessed. The property tax would be enormous. We don't want to do that. That's going to cause a disaster. Well, that's the way it used to be. Now we have a new system, so maybe that's on the table. So we have a number of things to think about with Proposition 19. So again, what is estate planning? Meeting with the attorneys and doing the will, trust, power of attorney, healthcare directive. It's really to do these things is to avoid conservatorship. That's if you can't act for yourself because of old age or disability, the court appoints someone for you. To avoid probate, again, that's if your property doesn't automatically transfer to the next generation. You have to go through a court process, very expensive. To preserve family wealth, again, going through probate. I usually offer this in the group. Guess how much it is in attorney's fees to probate a $1 million property? Can you believe? Generally, it costs about $22,000. Very, very expensive. And as we'll see under the new Prop 19, may not be what you want. It may not be the way that you should descend property, because there can be better ways under the new Prop 19. And again, streamline distribution to make it efficient, and special needs. If you're dealing with anyone that's a special needs beneficiary, how to take care of them. Or we need to add also international persons. International persons, sometimes there's some special considerations there. So one of the things, though, that I do tell everybody is say no to fast food estate planning. So again, estate planning requires you working with your professionals. And I always draw a contrast between this. As I say, the creation of an estate plan and a tax return. So for years and years and years, I worked for the Internal Revenue Service. And for a tax return, if our earnings, if let's say my earnings and Coco's earnings are the same, when we put our numbers into the tax return, we should all get the same number. It should be exactly the same. But I bet you Coco and I are not going to have the same estate plan. We have different family structures. We have different preferences. We have different wants and needs and different arrangements of our property. So our estate plan is not going to look like a tax return. So of course, a tax return, you can just throw all the numbers through and it should lead to the same answer. An estate plan, I've never seen anybody where the estate plan is exactly the same. Everybody tailors them their own way. So I say no to fast food estate plans. Tailor it to what you want. And as we'll see for Prop 19, there are actually some rules that we now have to incorporate that are a little bit different than the way it used to be. So one of the last things that I wanted to mention is we are in the year 2000, a year of very, very strange things going on. So I do mention a little bit about COVID-19 and estate planning because some unusual things have come up. One of the classic things, like I mentioned before, which is also quite important for Proposition 19 is, of course, we often think of ourselves first for the estate plan, but also think about people around you, for one's parents, brothers and sisters, especially brothers and sisters or other family that are single persons. They're actually quite difficult to plan for because the law doesn't automatically plan for them. If I'm a married person, I'm married with a spouse and I have 2 adult children, if something happens to me, of course, community property goes to my spouse. Separate property divided between my spouse and my children. That's probably what I want. But if I'm a single person, maybe it's going to go differently. It's probably going to go to my parents if they're still living. If they're not living, maybe my siblings. And that may or may not be what I want. So think about the people around you. They may need good guidance. The new thing also, which is very important, the Advanced Healthcare Directive is very important because with health situations due to the COVID-19 situation, the ability to make sure that the one you want to make healthcare preferences for you is the one who actually does it is, of course, of vital importance. The other thing is power of attorney. Durable powers of attorney have been very helpful recently. I had a case earlier this year, kind of an interesting case. We did the estate plan for the family, created a durable power of attorney. It's a functioning marriage. Everybody's happy, husband and wife. They wanted to sell a property during this time. And husband was stuck in China. He couldn't leave because of the COVID-19 situation. And he couldn't even leave his house. This was really in the early part. This was about March or April. And his wife and of course the family said, we really need to sell that house here. And lo and behold, we did their estate plan. They asked us, they said, is there anything you can do? I said, well, he did a durable power of attorney. It was immediately effective. It's right in his estate plan. Go get the binder that I drafted. Send that to the title company. He can sign with that. You can sign on his behalf. No problem. Works great. So again, have you done power of attorney? Have you done planning? A lot of times people think planning is for, if I pass away or I'm incapacitated. But planning is good, and we'll see it with Proposition 19 as well. Planning can be good for right now. It can help you in your ordinary life transactions to avoid trouble and difficulty. The other thing is, I always get one of these cases, and I had another one of these this year. We're up to, I think, 7 so far this year. Is your estate plan safely deposited? Is your estate plan in the place that it should be? The joke that I make, which is a situation that happens every year, and as I mentioned, we have about 7 cases. Be very careful where you put your estate plan. If you've already done your estate plan, be very careful if you put your plan in a safe deposit box and the person who is the trustee or the executor does not have access to the safe deposit box. You start to have this chicken and egg problem of that the plan that gives the person all of the powers as the executor and the trustee and the power of attorney agent and all these things is locked inside a box, which can only be opened by the power of attorney agent or the executor or the trustee, but the proof that that person is the trustee is inside the box. And I've up to about 7 cases so far in my career. I get one every year of the person says they have a great estate plan. It's locked in the box at Comerica Bank and the bank won't open it up. And unfortunately, you often have to go to court to get an order to open the box to get the estate plan out. So again, think about where are you putting your estate plan? How's it stored? Because that can be a big problem. And then the last one is, Has your estate plan made provisions for your minor children, especially for international families? I have a lot of international family clients, and it's very important that your estate plan is tailored for minor children. If their guardian is going to be a non-US person, you're going to need some special provisions to make sure that's doable. So I start off our little chat here with some of this just to start us thinking about the estate plan before we jump into the Proposition 19, because we're going to start to see how Proposition 19 works together with these things and where that comes into play. So California law changes. The big one is Proposition 19. The smaller one is the California homestead exemption is now, as of January 1st of this coming year, will be $600,000. We finally get some asset protection in California. But what we're here to talk about mainly is Proposition 19. And the best way to think about Proposition 19 is to think about it in sort of two chunks. There's really a third chunk, but that's for the government to deal with, of how they spend the money that they're going to get from this. So we don't really have to worry about that chunk. Let's talk about the first part. The first section of Proposition 19 is, what does Proposition 19 do? And the first part is, as I mentioned, so the good and the bad. And then, as we mentioned with the title of Act Now or Forever Hold Your Peace, we're going to see there's going to be a deadline for part 2. But part 1, what does it do? The good part. Well, it does something, it solves a problem that we've had in California for a good long time. And part 1 of Proposition 19 enables those over age 55, severely disabled, or fire disaster victims to transfer their property tax assessment for their primary residence to a new property located in any county in the state of California. So you may have dealt with this before for your older family members, is that it used to be there were certain reciprocal counties. Some counties would let you transfer it, some counties wouldn't, and you'd always have to work with, oftentimes, your real estate agent and broker, your accountant, and sometimes your lawyer, and say, well, wait, I'm in San Mateo, and I'm trying to go to Santa Clara. Is that one okay? Oh, wait a minute. Okay, I'm in Santa Clara, and I'm trying to go to Yolo County. Oh, I don't know if that one's okay. Or I'm trying to go from San Diego to Los Angeles. It was a lot of problems because under the old system, it was not universal. I couldn't go from San Mateo to wherever. I couldn't go from Santa Clara to wherever. So a good thing happened. We said, we're going to solve this for older Americans and older Californians. So again, generally over age 55, severely disabled or fire disaster victims. And the solution that they created was pretty good. They say, okay, if you fit one of those categories, you can transfer your property tax basis for your primary residence. And we're going to give you a little bit of time. You don't have to do it immediately. It's not going to be like, as many of you have probably worked with Coco and her team, maybe doing a 1031 exchange, and you thought, wow, I had to do that. So many deadlines. It was so difficult. There are a lot of deadlines that the title company kept making me meet. That was kind of a hard one. You'll find with Proposition 19 that actually purchase of the replacement property or transfer to the replacement property can be done within 2 years. So there isn't a major crisis if you sell the property, and maybe, let's say, parents live with children for a little while. They live there a few months before they finally settle on the property that they want. It's okay, as long as you select and file the application to claim the benefit within 2 years of the transfer sale of the first. So we have a relatively good length of time that we can do this. We're not going to be rushed, so that's good. That's a good fix. And we actually increased the number of times that we could do this. Under the old system, the really ad hoc system of certain counties, oftentimes you could only do it once. It's kind of a use it or lose it, and you could only move to certain counties, and it was a little bit awkward. But after Proposition 19, this can be done no more than 3 times. So you get 3 bites at this. So if you're over 55, you basically get 1, 2, 3 moves, which is pretty good. So again, classic example of somebody, if one's in, older family member in, Palo Alto, or they're in, Los Altos, and they say, gosh, I have a really valuable property, but I came here in, in the 50s and the 60s. My grandmother, God bless her, lived to 96. She bought in Los Angeles in the 1940s. I think it was 1946, bought the first house. Needless to say, the property tax basis was like nothing at all. But again, she wanted to keep that. Under the old system, very hard to do because very hard to move county to county. That all is fixed. And now can do it 3 times. The only thing that one does have to remember to do is when you utilize this system, when you're going to use the Proposition 19, you do have to file an application to claim the benefit. So when you find your replacement property, you'll have to file a Board of Equalization, a local county application to say, okay, I came from Palo Alto, I came from San Francisco, here was the old residence, here is my new residence, and fill out that form and get that to them. And then you can claim your benefit on Proposition 19. So this part is the good part. This part, I think, will help many older Californians to not be stuck in properties that maybe it's too big. It was appropriate when they had a family. Now they'd like something kind of nice and efficient and compact, and this will enable them to do that and not have that problem of saying, well, gosh, if I downsize and I move to a home that I really like that's suitable for my living, I'm going to have to pay the fair market value property tax. That's gone. So great thing for older Californians. But there's always a but. So the making of laws, there's always a but, there's always an exception, and what Congress giveth, Congress taketh away, and what the proposition system giveth, the proposition system taketh away, and there's something taken away by Proposition 19. So the second part of Proposition 19, what does it do? It changes the system of parent-to-child transfers. So the things that you know about the old Proposition 58 and the old Proposition 112, well, that's different. That is going away. Proposition 19, to a large extent, repeals Proposition 58. So what is this? What does Proposition 19 do here? So parent-child transfers of a primary residence are going to be, that used to be considered excluded from reassessment, is going to be excluded from reassessment in a different way. So the way it will work now is that parent transfers of a primary residence, it has to be primary residence, to a child or children who continue to use the primary residence as a family home do not trigger the reassessment. But the key language is who continue to use the primary residence as a family home. The old system, Prop 58, didn't care whether or not the children use the parents' primary residence as their family home. In fact, most people didn't. So the old 58 didn't matter. The new 19, it matters. So if the family has, let's say, whichever property, they have the Los Gatos property, San Jose property, Los Angeles property, wherever, and this property goes to the children, and the children say, no, I live in San Francisco and I live in Oakland. We're not going to go move to the San Diego house. We're just going to rent that out. That's going to be a problem because new Proposition 19 says, well, unless you live there, unless the person who's going to be the transferee of the property is going to use it as a primary residence family home, we're going to reassess it. So that old system of hanging onto that property as a rental with a low property tax assessment, that is gone. That is not going to happen anymore. Now, one will have to consider that that's going to be reassessed. And we got a cap on this. Is this the old Proposition 58, the transfer exclusion from parent to child, used to be for an unlimited amount. So if the amount that increased was over $1 million, you bought the property very, very low, and it's Palo Alto or Los Gatos or even Cupertino, one of those hot areas, and you had more than $1 million over your initial tax basis, the old system said, doesn't matter. Parent, child, good enough. We keep the old one. The new one's going to say, oh, no. We're going to take your old basis. We're going to add $1 million. For anything over, we're going to add that onto the assessment. So we're actually going to increase the assessment for amounts over $1 million. So for high value property owners, you're going to have a little bit of a challenge for this because the unlimited system is now gone. And Proposition 19 did this. It said, so this is what you get, because we're taking out the code that said Proposition 58, and I have the joke here, and nothing else. So that's all you get for the parent-child reassessment exclusion. That's what it means now. And we'll see that's what it means after February 16th, 2021. And I have the slide here. But wait a minute. As I see, panicked faces amongst, everyone in the seminar, they say, wait a minute, wasn't the old system unlimited for the primary residence? Couldn't I have, acquired the property for $500,000, but now it's, $2.5 million? Didn't it not matter under 58? And wasn't it that my children didn't have to live in the property at all? Couldn't it just, they could live anywhere in the country, and all they have to do is sign the BOE, 58 form? And wait, didn't I also have this $1 million wild card they could stick on my rentals and my commercial property? Didn't I have these three things, before Proposition 19? And the answer is yes, yes, and yes. And it's all gone as of February 16th, 2021. So this is the bad part. This is the part where the proposition taketh away. So things that we used to like to do, like the unlimited exemption for the primary residence, that's going to be gone. The requirement for the children to live in the property, that will be here after February 16th of 2021. And the exclusion, the sort of wild card that you could stick on other properties, rentals or commercial property that used to go to those other properties, that is eliminated. That is gone. So a lot of these systems that we used to do, they are no longer with us after February 16th, 2021. So what should I do? What should we do about this? How should we handle this new Proposition 19? Some of it is unclear. It's a little bit unique in this proposition, partly the way the proposition systems work, is that they have an effective date. Luckily, it was an effective date as of February 16th, 2021, and not January 1st. Usually, when the legislature does this, they usually give us a year and give us a year to figure out what to do so we can plan and plan efficiently, and also to enable the Board of Equalization and the counties to issue guidance so we actually are relatively certain what is required. For example, as I'm sure we'll get questions when we go into the question sections here, is they say, well, wait, how long do the children actually have to live in the house? What if they live there? What if they say they live there for 3 months and can we claim it? What about 6 months or a year? Or is it 5 years? Please tell me, Michael, what is it? What's the answer? And I have to say, I don't know, because the Board of Equalization does not yet know. They have not issued what's called regulations, which is basically their understanding on this. So some of these things are a little bit up in the air, some less so. So we'll talk about some 4 things that we can think about of what maybe we should do. The good part, back when we talked about part 1, older Californians over 55, can they move? That's an easy one. That's a no-brainer. If your parents or grandparents, they want to move, enjoy. That one's easy. That one's no problem. Not a big consideration to think about or puzzler over there. But for part 2, the parent-child part, there are some issues. So what should I do? One of the things to think about first, again, and going back to that intro of estate planning, is think about your primary residence and your distribution pattern under your revocable living trust. Does it work under Proposition 19? So here's a problem. What if my revocable living trust says to my son, my daughter, and my second daughter in equal shares, and I have a primary residence, and it's 1, 2, 3, they each get thirds. Under the new Proposition 19, do they all have to live there? Because I don't think that's going to happen. Do they all have to live there? if you look at the old BOE interpretations for this under the old Prop 58, most lawyers I'm talking to draw the conclusion, yes, if you have a revocable living trust or a will that gives a third, a third, a third, they're going to say for whoever lives there, he or she can keep 1/3 of the assessment. The other 2/3 will probably be reassessed. So what do we see? Problem. Think about your revocable living trust. Is the distribution pattern, maybe you need a Proposition 19 provision that says my primary residence shall go to the person who lives there with first priority. And if no one elects to live there, then it will be divided into equal shares. Or some structure granting someone an option. There are a number of structures that the BOE has allowed under the old Prop 58, such as granting options or giving somebody a right of first refusal that, son, you have the right of first refusal to live there. If not, we just sell it and divide it between you and your 2 sisters. BOE says that's okay. So think about your planning with your revocable living trust, because maybe you have a provision in there that's going to cause a collision with Proposition 19. Because again, the old BOE interpretation, which I'm highly confident is going to be the interpretation now, is that all parties, if you receive equal shares, 1/3, 1/3, 1/3, you're all going to be bound by the requirement to live there, because that was the old rule under Proposition 19. And if any of the siblings buy each other out, so here's a classic one. A lot of people say, well, wait, what if we just say, okay, son's going to live there, and the 2 sisters, the sisters will just buy him out, and they'll just, borrow and or the son will live there, and he'll just get a loan on the property, and he'll buy out the other 2. The BOE says that's not a parent-to-child transfer. The parent-to-child transfer was parent to son, daughter, and daughter. His buyout is transfer from brother to sister and sister. And we've always reassessed that, and we're going to reassess it now. So again, your trust may have provisions that are going to cause a problem for this. So keeping the primary residence low property tax assessment is important. Come talk to us about how we can make an amendment or adjustment to your revocable living trust to make sure that that happens. The next thing to consider is that we have something a little bit on a time fuse. Do you have secondary properties, rental properties or commercial properties, where you want to transfer them to children before February 16th, 2021? So let's say if I have the Tahoe condo or the Tahoe vacation cabin, or I have the La Jolla beach house condo. They say, oh, it's the Tahoe cabin. We always do Christmas at Tahoe, or we always do summer, at the Newport Beach house, the Newport Beach, beach cottage or something like that. And, we want it to stay in the family. Well, under the new Prop 19, that's going to be reassessed. Doesn't matter how that's working, that's going to be reassessed. So one of the thoughts is if I have, let's say, the Tahoe cabin, or I have the beach cottage, I say, well, the children are grown and I really don't want it to be reassessed. Maybe I should transfer that now and use the old Prop 58, because again, Prop 58 is still good until February 16th, 2021. Maybe I should transfer it to my son or daughter, or a combination of them, and they can file the application now before that date and say, no, we want to keep mom and dad's property tax assessment. We want to keep it low. That can be very, very important for secondary properties, rental properties, because as you well know, as savvy real estate people, that when the property tax changes, especially if you've had a lot of appreciation, that changes the cash flow of the property immensely. Especially for little vacation rentals like, the Tahoe or the La Jolla property, where you say, I really don't rent it out that much. Maybe I rent it out a little bit in the winter, or I rent it out a little bit in the summer, really just to cover the property tax and the insurance. But other than that, I keep it empty because the family likes to use it. Well, that's going to be a big problem, because if the property tax is substantially increased, you're going to have to monetize that property a lot more. The same thing goes, this is item 3, same thing goes for your parents' property. You may think, well, it doesn't really matter to me. I'm all set. I've done all of this in advance, or I'm planning to do it. Think about your parents, do they have the Tahoe cabin? Do they have the La Jolla property? Or even the primary residence? Is their primary residence, that classic example, they bought the Palo Alto house in the 40s and the thing's worth $3-4 million now. And you actually plan to live in there. And you say, no, I plan to live in that property. It's a beautiful Palo Alto house, but okay, I plan to live there. I'm okay there on Prop 19, but there's more than $1 million of appreciation. Maybe we need to talk about transferring that before February 16th. Maybe that could be an issue. For both, of course, 2 and 3, we have to think about some income and estate tax issues. When you transfer the property, if it's income producing, that's going to move income from the generation who had it to the generation where it's going. That may be good, that may be bad. If parents are older and they're on a fixed income and the rental may cause very little income tax for them. But if the child is a top engineer in Silicon Valley, that may be really bad for his income taxes. But you'd have to see, maybe it could be worth it. Same for estate gift. You have to look at the size of the gross estate, look at prior gifts, look at all those things, make sure there's no looming estate gift tax issue that could cause a problem. One last thing, this was something to kind of correct in some prior lectures. As a lawyer, we love business entities, but what I love more than business entities is good legal work and doing things correctly. So I've always been a little bit lukewarm on using LLCs for rental real estate if it wasn't commercial. Commercial, 9 times out of 10, I'll say, yeah, the commercial property should be in an LLC to shield you from liability. But I've often been lukewarm on it for residential property, especially condos and townhouses, because it causes problems with the loan, it causes problems with insurance, it causes problems with the tenant, and under the old system, it caused problems with Prop 58, because under the old system, Prop 58, when you gave the rental parent to child, and there was less than $1 million of change in the assessment, if you gave it straight title, parent to child, they got to use that Prop 58 and keep the old property tax. If you used an LLC and the LLC membership interest went from parent to child, you lost it. So under my old lectures and my old seminars, I used to tell people to be very careful about the LLC for that reason. After February 16th, we don't have to worry about that. So if you were holding off on the LLC for a rental property because of the old property tax rules, maybe you can rethink that because again, those rules will be over after Proposition 16 has the effective date of February 16th, 2021. So that's the California, the Proposition 19. I just want to lead off or end off with one other thing that's very important about federal law changes and something to be aware of with federal real estate transactions that is quite important that we have to be careful of, particularly because we just had an election. So we should be aware of this. 3 things here. One thing for everybody to remember for the federal estate and gift tax. Remember, California does not have an estate gift tax. That's one tax in California we don't have. Used to have it in the 80s, but got rid of it. The federal or the California estate gift tax, that's gone for California. Watch out, Minnesota, Washington State, Oregon, they have a state estate tax. Have to watch out owning property up there. But let's just talk about what we see for Californians. This is the federal, this is the national estate and gift tax. I think not much is happening here except what is already the law is do be aware, and I have a lot of clients that sometimes have misconceptions on this, is that the $11 million per person exemption, this is for the federal estate tax, the $11 million exemption ends December 31st, 2025, and it will go back down to the $5 million level January 1st, 2026. So again, if you or your clients or friends and family are high net worth individuals and you say, oh, 22 million, we're not going to have any problem. We're only about 7 million now, or we're only about 8 million now. We're not going to have any problem because it's 22, that you only get the 22 if you die before December 31, 2025. And all of my clients intend to live way beyond that. So again, that planning doesn't work if you're using that as an excuse to not do something. You can utilize it for gifting and you can utilize it for other special structures, but you can't just relax and say, well, it's $11 million, no problem, because it's not going to be $11 million permanently. It's already in the law that that's going to change. It's just built in. It's called the Tax Cuts and Jobs Act of 2017, just built in there, $11 million until December 31st, 2025. Then it's kaput and goes back down to the old amount of 5 million. And then also remember, common misconception I see all the time, how we calculate the estate. Common misconception about life insurance. If you have whole life insurance, the death benefit, if you own the life insurance and it's not in an irrevocable life insurance trust and you pass away, the death benefit is included in your gross estate calculation. So if you have the $4 million Palo Alto property, and then you have the $2 million of your, probably more than $2 million. You have let's say, but we'll say let's say $3 million. My 401k, my retirement plan, my wife's plan is also $3 million. So we're at 10, and then we have a let's say a $3 million life insurance policy. That puts us over 10. If we both pass, which is the expectation after 2025, that $3 million will be subject to the estate tax. I know a lot of times people say, oh, no, I heard it's tax-free, it's tax-free. The growth of life insurance inside the policy is income tax-free. But if it is not in a container like a life insurance trust, it is subject to the estate tax. So be cautious. It's super easy to solve. You come visit me, we do a life insurance trust, take it out of the estate, no problem. But I have a lot of people that forget about these life insurance policies, and that can be a big problem. Some news, the income tax. Watch the news about the income tax. There have been a lot of scary and kind of imprudent talk about the Section 1014 step-up in basis may get changed. The Section 1031 exchange may get changed. So keep an eye on the news about income tax because it will be interesting to see what's happening over there. And then the last thing is that for any, again, intra-party sales, this thing called the applicable federal rate, the AFR is very low and looks like it's going to stay low for the foreseeable future, for the next year or so. So the thing to think about for that is now is a very good time to do some aggressive planning if you're in the upper high net worth ranges, because there's a good, very good abilities for us to be able to move things efficiently. We can do it at a very low cost for the AFR. So things look good. So that is basically sort of going through about my sort of 15 or 45 minutes here, because I like to reserve some time for questions so we can talk about what is the concerns that you all have. And best way to contact me and my office, best way, email or use the QR code. The QR code to our WeChat is excellent, or email. Telephone is fine, but the odds of you catching Shawayer and I free are almost zero. So it's much better to use email, and then our staff can ensure that you get an appointment and we can talk to you and make sure things get on good shape, especially about the Prop 19 stuff. Because again, I think I'm going to have a lot of clients, early spring saying, I think I should do something about this. And the unfortunate answer will be, yeah, you should have done it a month ago. It's now, March. There's nothing we can do. The law is what the law is. So we have time until February 16th. And the key thing is really all of this needs to be done in January, because I expect the county recorders are just going to be flooded with filings. And the county recorders, because of COVID and being understaffed. They're having a hard time keeping up with all of the filings and recordings. So I think it's best to get that done as soon as possible. So that is my sort of recommendations there. So I'd like to open it up and see if anyone has some questions.
Great, this is valuable information. Thank you so much, Michael. Maybe we just have a little unshare the screen for a little bit and we can come back to our screen.
Let's
Thank you.
Let me release the share and oops, let me see here. There we go.
Okay, great. Thank you so much. We have been streaming live on Facebook, YouTube, and other platforms today. And we actually have compiled some questions that our viewers have for our guests. Before we get into the question and answer session, I would like to reveal the title of our next series starting in January. It is called Investors Medley and will be about different topics relating to investments and the business side of real estate. Investors Medley will start on January 5th, 2021. The topic of the first seminar of the new year is 1031 exchange, and our expert will be James Kahayes from IPX Exchange. So if you own an investment property, you should be familiar with the section of the Internal Revenue Code that allows you to defer capital gain taxes. James, I believe you're online. Can you please give us a quick preview of what you will be discussing?
I'd be happy to. So, and I heard some of the things that were mentioned, and there has been rumor about the 1031 exchange. What I'm going to do is provide an update on exactly what's happening in Washington, where we see things in the future, how much it is actually on the radar. I would like to start it off with that. I'd like to do a little bit of review on the 1031 exchange. This was an incredible year that we thought come April was going to be horrible. It turned into a record-breaking year on 1031 exchanges. A lot of people have been doing reverse exchanges. I wanted to touch on that, improvement exchanges, and just go over some of the time frames of the 1031 exchange to make everyone very fully aware that this is the greatest wealth building tool that exists out there. And if you know how to utilize it, not only can you turn your real estate portfolio into a gold mine, but you can also increase your business significantly depending upon what you do. So what I would like to do is go over what's going to happen in the future, a kind of a review for 2020, what we foresee in 2021 from not only the political standpoint, but from the business standpoint, and then go over some of the important things in a 1031 exchange, including misconceptions and how to build wealth within real estate.
Great, thank you, James. So Investors Medley is coming up in the new year, but we still have a couple weeks left in December. So this is the perfect time for a light-hearted seminar for us to gather, network, and drink some wine. So next week, we will have a cooking seminar featuring a talented home chef, Michelle Chen Lee. Everyone has different tastes and different ingredients in their pantry. So Michelle will be teaching ways to give your favorite dishes a holiday-themed makeover. Just look at those photos. Bring an artistic creation like this to your next holiday feast to impress your friends and family. Learn all this and more by joining us next week for Festival of Flavors, a special holiday can experience. All right, now that Michael has had a few minutes to rest his voice, it's time for the Q&A. If you have a question, type it into the chat or use the raise your hand feature in Zoom. So I have some questions here actually. Let's start with the one in the Zoom. From Jackie, can someone borrow $150,000 from me without triggering gift tax by my gifting him $15,000 each year for the next 10 years without him returning the borrowed money to me? That sounds like a tax question.
Yeah, and that's actually a fine question. So I think that my concern, or how I'll answer this question is, Jackie uses the word borrow. So if what's really happening is that you just want to do the gift, what it sounds like is that your intent is to just do the gift. So if you do want to just do a gift, you can, of course, just do the payments of $15,000 per year, and that does not require the filing of a gift tax return, and is not subject to gift tax, and is not subject to any gift tax reporting or anything like that. But the bigger issue on this is that if it's only $150,000, if you are not at the upper end of the net worth framework, if your net worth is far less than $5 million and you're a single individual, even if you gift $150,000, you are required to file a gift tax return, technically under the law, but you really will not have a result because filing the gift tax return does not cause any tax to be due because you're well within the $5 million exemption. So generally, I think that is probably not such a big concern. So you could do that. $15,000 per person is fine, or one can just file the gift tax return.
Okay, great. So from Frank, can you add the children to parents' title as joint tenants to avoid property step up?
So this does a couple of things. Some people do this for estate planning, but there are a couple of issues for this. First thing is just to be aware of the joint tenant system. If you add the children to the property as joint tenants, they become a partial owner of that fraction of the property presently. So one just has to be aware that if I add my son on as a joint tenant, there's a concern that if he files he goes to the recorder and files a severance deed for $30, he owns half the property. And I say, well, yeah, but that was a gift. I want to sell the property. I want to refinance it. And he says, no, I'm stuck with that. So if you're okay with that, and you doubt that that's going to happen, that's fine. The other thing is if he gets in an automobile accident and his insurance is not sufficient, that property is his. He can, or his half. So adding a joint tenant, one has to be somewhat cautious. The other thing is that just adding them as a joint tenant for the half that they're added on presently, if it's done before February 16th, 2020, they will be able to keep the parent-child exclusion for that portion. They don't have to live there. But then if the person then passes away after February 16th and they get the other half, that half, depending on the value, if they continue to live there, they'll get the other half without a reassessment, providing it's not over $1 million. Usually I discourage using the joint tenancy deeds for estate planning purposes. They're usually a little bit clumsy. Usually I prefer the revocable living trust is a better way to do it. But people have used them before, but it's not really what I would recommend.
Got it. Gilbert and a few other people asking for slides from the presentation. So I think maybe, Michael, you can email to me and I will distribute to people who are interested.
Exactly.
So,
yes.
Great. So for anybody who's interested, please email me at cocotangroup@gmail.com. COCOTANGROUP@gmail.com. And Justin, if you can help me type in the public message, and then we will email everything out to people who are interested. From Santosh, the 55 age for transferring base for both spouse, is it for both spouses or any one of the co-owner over 55 will be sufficient?
Most likely this will be any one of them. So generally, it seems that they're not going to take the position that both persons have to be over 55. So I believe, again, it's not super clear in the current law, but my expectation would be that they would allow it if one of them was over 55, you could bring it. You would not require both persons to be over 55.
Great. From John, can I sell my one primary home and transfer tax assessment to 3 houses?
No. That's clear in the law. That's not going to work.
Just one, right?
Yeah, has to go from primary residence to primary residence. You can't divide it up because this is for part 1 of the Prop 19. It's trying to protect senior Californians and their property tax assessment. It can't be divided amongst rentals.
Okay. From Rupa, to get the Prop 19 benefit of returning the property tax of primary residence, should I sell my primary home and move to another home, or can I keep the primary home as rental and move to another primary home?
You can keep the primary home as a rental, but do be aware it will be reassessed. So when you take it, so most people I think will sell because if I keep my primary residence and I move the assessment to my new one will have the old assessment, but my old home will be reassessed to fair market value. So it's not as if I could keep the old assessment on the other one and then move it to another one. That old one's going to be reassessed if I still own it. So that one, I think I envision most people will probably sell.
Oh, wow. If you wanted to sell your primary home, call this number. So call me. Okay, that's good. From Linda, for over 55 years or older, is it possible we can buy the new home first, then sell the old one, at the same time get the benefit of the property tax transfer?
This is a little bit unclear, actually, but I think you could probably do this. Is because basically the situation is that they allow sale or transfer. So even if you already owned multiple properties and you had two properties, and you said, well, what I'm going to do, I live in this one, and then I'm going to move to this other one, and I'm going to sell that one. Generally, I think that would be all right. It's not crystal clear, because there are no regulations, but generally, I think that would be a fairly likely interpretation.
Got it. From Venkite, under the old rule, when you transfer the cost of the new home should be less than or equal to the price of the old home. With the Proposition 19, how does it work?
Oh, the old rule, I think there's a little bit of a misunderstanding of how the old rule worked. The old rule was a county by county system, and generally was that if your old assessment was lower than the new assessment, you could bring over the old assessment. If you bought a cheaper property, you would just use the new assessment, the new lower assessment. Even under the new rule, I believe you would do that. If you had an over 55 person and their property that they had was higher, they would choose the lower one.
So the difference is really just you can buy a more expensive home rather than buy something cheaper.
Exactly. And a lot of times, though, what happens is it's not even necessarily buying a more expensive home. A lot of times what people have is like, especially for older Californians, they bought the Palo Alto property or the whichever property years and years ago, 60s and 70s, and their assessment is very, very low. Maybe it's $500,000, and they say, well, even if I buy a property that the fair market value is much lower than my property, it's still not going to be $500,000. It's still going to be more than that, and that's where the Prop 19 is trying to help those people because they want to keep their low assessment.
Got it. Going back to the question earlier, have a few other questions in the back as well. So usually people try to, when they try to move, right, they get their new primary home, and then, but for the existing primary home, they can actually rent out for a few years until they can, maybe 3 years, and then for 2 more years, as long as they live there for 2 years out of the 5, they can still sell for capital gain exemption. But you're saying now, before they even sell it, they can actually reassess your property.
Oh no, not before you sell it. It depends if you use the transfer. So you could do something like this. It's really, and this is going to be a little bit of a timing issue. Is that if you have a situation where you do own 2 properties, if you do apply to move your assessment to the new property immediately, it's going to cause the reassessment of the old one. But what you could potentially do is move and then wait a year to file the application, but you have to pay the higher tax. So it's going to be a timing issue, and a lot of these timing issues, very hard to say how they're going to work because we don't yet have regulations to basically tell us how to interpret it.
Got it. I think Frank's question, what is assessment based on? Assessed by county or sale value? I guess that's actually ties into what you just mentioned, right?
That is assessed by the county. So generally it's assessed by, there's the sale value, and then the county, the county assessor has the ability to say whether that sale is the fair market value. Usually in Santa Clara County, they're fairly conservative, and they assess about the sale value, but it's based on the county's assessment.
Got it. Okay, Frank also asked her that one can also maintain the property tax basis upon inheritance if you have a step up. Is that true?
No, the property tax basis is based on the California law, either Proposition 19 or the old Proposition 58. So just because there's a step up in basis for the federal tax system under Section 1014 does not mean that you keep the state property tax basis based under state law. Two different legal systems, two essentially different governments in charge here. So if you have the 1014 basis step up, which, let's say my example, you have a parent and you have 3 children, and they inherit the property, a third, a third, a third, they will all receive the property tax, or they will all receive the Section 1014 income tax step up. But under new 19, only the one who lives there will receive the Proposition 19 property tax exclusion. So if 2 of them don't live there, there's going to be a reassessment.
Got it. From Tito, if the kids are too young, what is a good solution? You need property in your name for refinance, selling, city building, etc.
There's a solution to this. So if there's a situation where you have let's say a rental property that has this issue, and you say, the kids are too young, one thing one could think about in a case that was suitable is doing an irrevocable trust, where the children were the present beneficiaries of the irrevocable trust, and you gift it to the irrevocable trust before February 16th and claim the exclusion. If you do that, of course, you have given away the property, the funds and the value of the property has to stay in the trust for the children, but you can, as the trustee, manage, refinance, sell the property, all of these things in the irrevocable trust. But the key thing is you can't take out the money. The money is for the kids. If the thought is, well, that was always for the kids' college fund and funds in the future anyway, that's what I was planning to do, then maybe it's appropriate. It's a complex strategy, but it is possible.
Got it. From Nima, can I just give my property to my children so I could just avoid the reassessment since I have the $11 million lifetime exemption?
For some situations, you could consider a strategy like that. For, let's say, a rental property, or if you have a primary residence that has very, very high appreciation that you think the kids are going to live in for a long time, you could consider doing that. You just have to think about, there's a few different taxes that we're looking at. We get to keep the local property tax reassessment low, but do realize that you sacrifice the step up in basis when someone inherits the property due to death. So it's something that we generally look at on a case-by-case basis, because each case is a little bit different.
You have solution for everything, huh?
We can usually solve most problems. I'm in the problem-solving business.
That's good. From Jacob, can property be transferred from a grandparent to grandchildren as a non-primary residence? Grandparents and children, the grandparents are still alive. So basically, can they do that without triggering a tax reassessment under the old, which is the pre-prop 19 rule?
And the 112 system? Unfortunately, not. Generally, the transfer from grandparents to grandchildren required that the parents be deceased. If the parents are living, generally you cannot take that exclusion.
Oh, okay. We would rather them living though, so.
Yes, of course. So we'd rather that situation, but that is the way the law works.
Right. From James, can I move out of the old property, rent it, and then move into the new one to get the property tax benefit? And after a year, keep the exclusion money and 1031 exchange the rest?
And this is the timing rules. I think something like this is possible. And I think it's not so clear under the regulations, but this is partly why I think there may be this 2-year rule for claiming and when the Proposition 19 actually becomes effective, because 2 years is kind of a lot of time, because under other property tax exclusions, oftentimes they have things where they say you have to file this thing in 90 days. You have to do this, very, very quickly. This one they give 2 years. So I can't, make an exact, conclusion as to could you do this exactly. But I think the BOE, and when they were creating this, was hinting that you could do something like timing, where you could exit, rent, convert the old one from primary residence to income producing, move the assessment, and you could time this right, and to enable 1031 exchange or other solutions, rather than doing something where like, other things where there's like a 90-day rule there.
Okay, this may be something creative, James, and can we can discuss with us next session on your 1031 exchange session. From our CPA Bean, how many years after the kids use the parents' transfer house as primary home, then they can put it as a rental property and not trigger property tax reassessed?
And this is a huge unanswered question under Prop 19. They have not outlined something like a safe harbor. A safe harbor is usually they say, okay, if you stay here 6 months or a year, that's automatically enough. There's also, because this was passed, through the proposition system, there are no regulations on this where they've issued any regulation or interpretive guidance. So for that, it's really unclear. It seems that if the children or one of the children, it's easier if it's just one person, use the property as primary residence for 6 months. That seems like enough, and they really did, and they really and this is the thing that I think is going to cause a little bit of trouble under this new Prop 19, is you're going to have all of these facts and circumstances questions about whether the kids use it as a primary residence. They're going to have their income tax filed from there. They should register to vote there. They're going to have to do all this stuff. It's going to be very messy. And this is a little bit strange because usually for property tax, they don't like things messy. But this seems to be, the situation that is the case. So it's not quite clear how many years or how many months after the transfer is done do the kids actually have to live there. It's still an open question.
Our CPA had the tough question for you.
It's hard. And I think everybody's asking this. We talk to lawyers and CPAs, and because our clients ask, and we say, well, they say, the client asks, how long do I have to live there? And it's hard because we say, I'm not sure. Generally, some things, it's been a year. How do you prove it? How do you create your burden of proof file? It's a little tough.
Yeah, it's still new, I guess, right? So,
very new.
Yeah, very new.
Just since November.
That's right. We're not exactly. We're not in February yet. Yeah. From Shirley, how does the Prop 19 apply to secondary home?
What does it do for secondary homes? It eliminates the old Prop 58 system where you had this sort of wild card, this extra exemption that you could prevent reassessment for rental property. Now, under Prop 19, all rental property will be reassessed when it changes ownership from parent to child. So that's the major difference, is that there is no protection for rental properties anymore.
Okay, so from Santosh, it says this proposition passed through. He felt that this disadvantageous for most of the people. I feel that it was worded in a way that misled voters. Any thoughts?
This is a fun one. I'm going to take off my lawyer advisor hat here and just kind of editorialize. It was a proposition, and these usually are pushed by interest groups. And I'll just read you something funny this is literally in the law. This is the findings of fact for part 2. And this is the header. So the header says, what's Proposition 19 Part 2 for? It says, to limit property tax increases on family homes used as a primary residence by protecting the right of parents and grandparents to pass on their family home to their children and grandchildren for continual use as a primary residence, while, and again, this is from the original law, this is what it says. It says, while eliminating unfair tax loopholes used by East Coast investors, celebrities, wealthy non-California residents, and trust fund heirs to avoid paying their fair share of property taxes on vacation homes, income properties, and beachfront rentals in California. This is literally the law. This isn't me making this up. This is what it says in the statute. So yeah, I think Santosh, you're right. There was a little bit of policy entrepreneurship on this one.
Anyhow, back to Frank's question, and I think this is the add-on. If you have had a rental property for many years with a parent as joint tenants and the parent dies, do you get a step up in cost basis? I am also in the parent's trust.
Okay, so here's this one. So we're talking about, let's say step up. So we're talking about section 1014 of the Internal Revenue Code. We're not talking about Proposition 19. We're talking about 1014 IRC. So if you have the rental property and you're on with parents, so you have parents and the step up in basis is on the part that is transferred to you by operation of the joint tenancy. So if you're on as 50-50, 50% gets stepped up, but not 100%, only 50%. So again, that's a problem for these joint tenancies, is because if I don't, naturally, I'm part owner, only the part that's passing through the joint tenancy gets the step up in basis. So his section here says, I'm also in the parent's trust. Generally, what would be better would be that the parents and basically, whoever is the joint tenant, perhaps, Frank, you deed off back to your parents. Your parents hold as 100%, and then it's conveyed via the revocable living trust. That way, you'll receive 100% step up in basis. But if you're on title as a fractional joint tenant, you only receive it on the fraction that passes due to the joint tenancy. So this is a tax problem with joint tenancy deeds, is you don't get a 100% step up in basis. The magic one, this is the magic one, is allow your parents to hold the property husband and wife as community property if both persons are passing. If they hold husband and wife as community property, and it is community property, it has to legitimately be community property. When the first spouse passes, 100% gets step up in basis. The surviving spouse could sell it, no capital gains. It's just stepped up right from there. A little bit different answer. If let's say, for Frank's situation, you put in money and you were joint tenants, then it's a little bit different because you actually do own part of that property. We'd have to take a look at it. But that's sort of the general aspect of the Section 1014 step up in basis, that you have to be aware that if you're a joint tenant, you already own part of the property, so that part doesn't get stepped up when you inherit the rest.
Got it. It's not a straightforward answer.
Yes, it's something you need to take a look at. I would say whenever you have a joint tenancy property, come talk to us, because a joint tenancy, it was never intended for estate planning. Really, joint tenancy, it's an archaic structure from English common law that was designed to prevent the land from being divided. It basically is, it's an old structure, seriously, from sort of the Lord and Baron's time, because we did not want the property to get split under brother and sister into fractions. We wanted all the land together. So for modern planning, it still exists, but you have to be cautious, because if used wrong, it can be really wrong.
Got it. So from Keqin, if the property is a rental property right now, and if I move into the property later as primary home, can I use it as a primary home, and can Proposition 19 apply when I sell the property and buy a new one? How long do I need to live in the property to qualify?
Oh, say again, Coco. I missed a little bit of the beginning part.
Okay, so he's asking if he has a rental property right now, if he moves into that rental property and later on basically move into the rental property after the tenant leaves and use that as a primary home. So can I use that as a primary home, and the Proposition 19 would apply when he sells the home? How long does he need to stay there in order to trigger Prop 19?
And this is another one of those of it's unclear how long. Is that currently it's not clear how long, whether you're supposed to stay there 6 months, whether you're supposed to stay there a year. The current Prop 19 does not give us good guidance. I assume earlier this year, and I assume the BOE is probably trying to work out regulations on this that will give us some guidance. But right now, I don't have a clear answer where normally sometimes tax law has what's called a safe harbor, where we say, well, if you stay there 2 years, it can prove it. That's good enough. But there's nothing like that out there right now.
Okay, so those are all like, if it's primary now and transfer to rental, or rental now transfer primary, we probably have to wait a little time and to see how the law plays out.
Yeah.
Yeah, from WW, my friends have only one child and they are legally separated. Can they have one trust as all their assets will go to that one child? Which kind of trust do they need to set up? And what kind of situation, in what kind of situation need to be irrevocable trust? Both husband and wife have one primary home. How Proposition 19 would work in this situation?
Okay, so this is kind of a complicated one. I'll give you sort of some general answer. Usually for separated persons, if they're legally separated but not yet divorced, I generally don't recommend the revocable living trust to be joint. They can each do a separate independent person's revocable living trust. But because as soon as there's a divorce, and even to some extent a separation, but especially a divorce, will terminate all joint estate planning. Doing joint estate planning while separated is not really a good idea. Each person should do their own plan. To get the step up in basis for Section 1014 income tax, they don't really have to do any planning for that because if you pass through a revocable living trust, it will automatically step up. An irrevocable trust, you have to be quite cautious because an irrevocable trust is irrevocable. It does lock the property for the benefit of the beneficiary, which may be the child. So that would be one that I'd say definitely need to contact me because it's a complex situation. You have to be cautious. But the few things to remember: doing separate planning is better, and be very cautious with the irrevocable trust.
Okay, from Venkat, we have a case study. Can you please tell me what would be the property tax basis for the new property if the tax base for the old property, say, is 500,000 and you sell it, you sold it for 1 million, then you bought a new property for 2 million, what would be the new property tax base?
Oh, so if you're using the over 55, if you're over 55, you could keep the 500. You could bring the old one. You have to be over 55, but you could bring if your property tax assessment in your old county was 500, you could bring it to your new property. You can see this is very, very good. We have to uncouple Prop 19 from the step up in basis or capital gains tax rules. They're two different things. So even though you sold it for $1 million, that's not the number that we use for Prop 19. We use your tax assessment that you originally had. So if your old property's tax assessment was 500, you can bring the 500.
So basically, what's the key? The key thing is what you bought, your cost base for your current home. And then it doesn't matter what your sales price is, what your purchase price is anymore, because it doesn't have to be less, it can be more, and then you can keep your current property tax base.
And it's basically look at your property tax bill, your assessment, that's what it will be. So whatever you on your property taxes, whatever that number shows that your assessment is, that's what it is.
So
And-
not original 500,000. It's basically they probably increased a little bit over time. So
Yeah,
you're-
1% or so. So it may be a little bit more. But as you can see, this is very good for a lot of older Californians that want to sell. Because if they were saying, well, mine's 500, even if they say, well, I just want to do the same thing. I have $1 million property and I want $1 million property, but my assessment is only 500. Now they can do that and they can keep the 500. A lot of people were prevented because they say, all I want is the same thing, but I want it closer to my kids. Now you can do that.
Makes sense. Yeah. Okay. From Jackie, I think want to clarify Proposition 19, the one the inherited heir who lives in the property value above 1 million, anything above 1 million would be reassessed. Is that correct?
It's whatever the old basis was. It's essentially whatever the old basis was plus $1 million. If it's over that, then there will be the addition of whatever's over. So if, let's say, the old assessment was $1 million, and then now it's worth $2 million, then you take the first $1 million, you add another $1 million, no reassessment. But if the new fair market value is $3 million, you take the old $1 million, you add $1 million, your property tax will then be $2 million because you have $1 million over.
Okay, thank you. From WW, if parents' main assets are houses, will TOD work the same as trust? If set up trust is better, is it still necessary to record as a TOD, transfer on death, right? So will the TOD end this year, and what is the transfer on death? What is the TOD still and can be done right now?
Okay, so for the transfer on death deeds, this came out just a few years ago. These, I generally do not recommend these for all but the lowest of value properties. This is, again, very sort of, we kind of joke, Holly Hobby estate planning. Why is the transfer on death deed not very good? Is because it only works on death. You don't have any additional benefit of having the active living trustee who can, let's say, if you have multiple properties, refinance, let's say you're incapacitated to refinance those properties. They're not able to do it. You just straight transfer. Also, you're not able to do any sort of mixing, matching, allocating inside the pool of the assets of the trust with transfer on death deeds. They just go over to whoever is named on the deed. So the problem with the transfer on death deed is that they're generally a little bit clumsy. So for sophisticated estate planning, I generally don't like the transfer on death deed. Usually the only time I recommend them is for very small properties for persons who say, I don't have very much, I just want to do something simple. Maybe the TOD is okay, but I don't really recommend it. If you do a trust, a revocable living trust, do not record transfer on death deeds, because that will cause transfers contrary to the trust. So if you do a trust, you have to record trust transfer deeds to put the real estate into the trust. Don't do TODs because they will conflict with the trust. And the TOD, there isn't any ending of the TOD. The TOD, that structure still exists. That law isn't repealed. It's just not something that I would recommend.
Oh, I thought it's going to be end this year.
Maybe, let me double check on that. I didn't hear whether they were going to repeal.
But I also heard it's not a good thing to use anyway.
I wouldn't recommend doing it.
So it doesn't matter anymore, huh? It's only it's going to be about 2 weeks left.
Yeah. I would, my strong recommendation would be not to even bother with the transfer on death deeds, and actually come to, I haven't really looked actually with the trend, because I never recommend these things. You might want to also kind of think of it this way. If they're repealing the transfer on death deed system, why? It may be because they're no good. And that's kind of the thing that I'd recommend is I never recommend them. I think the trust is far, far better. A classic problem, like let's say here's just, just go back on it, not to spend too much time on this question, but I like it, is let's say I do a transfer on death deed to my 3 children, and one lives in the property and the other 2 don't. If I had a trust, and I had the Proposition 19 provisions, I could probably inside the trust arrange it so that just the daughter or son or whomever lived there got the property, and then I gave other property to the other kids, and I saved the Prop 19 for the person who lived there. I can't do that with the TOD. It's just, it is what it says. So not a good way to do it.
Got it. Yeah. And from Rupa, I think this is a case study, just like, I think to repeat what we had just had, I think it's a good idea to do it one more time.
Sure.
If the private home they bought is $1 million, now it's $3 million, and kids inherited this property and living there as primary home, how would the property tax be calculated? Is it the same as parents, or will it be more?
Under the new Proposition 19, it would be like the last example. If the property tax bill says the assessment is $1 million, and then they inherit it after February 16th of next year, they will basically add $1 million of exemption. So they'll say, okay, 1 million original assessment plus 1 million of the exemption. Okay, the fair market value is 3 million, so we have 1 million to add. The assessment would be 2 million. So I would expect it to be 2 million.
Okay. Okay. And then what if they inherit it right now instead of after February 16th?
If you transfer it now, you can do an unlimited amount. It's just the children will now own the primary family home. For very, properties with very high gain, that the children, let's say, are adults, and everybody does want to live there, you may want to consider doing that. We'd have to take a look because there's a lot of tax consequences. But if it can prevent $1 million, which is $10,000 a year, prevent that bill from being set for life, maybe something to consider.
Cool. From Jay, on the step up, I heard that Biden administration may change that. So no more step up when property being passed to children. Is that true?
It's hard to say. I've heard this, and even in my slides, I mentioned it. I heard this. Unclear. It's not really clear whether this is going to happen. I think the thing is that we just have to follow the news. Generally, tax law is not enacted to be retroactive. So generally, we'll have some knowledge of what's going to happen, and then from there, go from there. So watch the tax news and keep in contact with us. I haven't heard any concrete proposal, but I've seen it put around every once in a while. So something to definitely watch for.
It'd be good to bring you back with all the updates in the new year. Yeah. So from Frank, further to my previous question, if parents dies and we have ownership via joint tenants of the rental property, is there a reassessment of property tax?
After February 16th, there will be a partial reassessment for a rental property. If it wasn't a family home, after February 16th, there will be a partial reassessment.
Okay. From Keqin, Proposition 19 takes away the property tax benefit when the kids inherit the property from the parents. If they sell the property right after they inherit the property cost will still step up. I guess the cost base will step up. The appreciation of the property will be based on the time the kids inherit the property. Is that correct?
Let me try to unpack this question. So let's see.
Proposition, yeah. So when they sell the property, if they try to sell the property after they inherit the property right away,
yeah.
So the cost base will step up. Is that correct?
Yes. So I think actually this, if I'm understanding Mr. Zhang's question correctly, I think a lot of people will do this, is that because Proposition 19, especially for rental properties, I can't keep the old low assessment. If the assessment is significantly increased and the cash flow of the property is not attractive, I will inherit the property and then I will quickly sell it. Because when I inherit it, I will get the federal income tax step up in basis, but so that's good. I won't have capital gains tax, but if I carry the property under Prop 19, I'll be paying at the reassessed value, which may be expensive.
Okay, that makes sense. Yeah. Mm-hmm. And then from Alan, if within a family, so parents and children, sister and brother, they add or drop an owner from the joint tenancy, there will be any income tax. Either any income tax must be filed or property tax will have to be reassessed.
Okay, so this is the thing to think about, and we have to take a look at a few rules. So if a family owns a property, all is joint tenants, it's going to depend on who is transferring to whom. If parent to children, if a parent is transferring to a child, old rule, there's no local property tax reassessment. After Prop 19, it's going to depend on whether it's a primary residence and whether the kids live there. Transfers of property between siblings, brother to sister, sister to brother, brother to brother, on and on, that's always triggered a property tax reassessment on the part that was transferred. So sibling transfers are not exempt. Parent to child transfers are exempt depending on Prop 58 or Prop 19. And then the second part, can married couples set up separate living trusts? Yes. Yes, married couples do not have to set up a joint living trust. It's an option. But if one spouse says, you know, I'd feel more comfortable doing my own thing for my half of the community property, the spouse can do it. It's just one has to think about community property concerns because there may be community property issues that are at play.
Great. And then from GC, I think this is the question just to recap. If you transfer parents' primary home to child, does the child retain the old property tax assessment or does it get reassessed? So your answer was the same property tax base plus 1 million exemption after Proposition 19, and anything above that will have to be reassessed.
Exactly.
Yeah.
So you
See,
just
I learned something.
I hope so. I hope that's what we're trying to do. We're trying to get some good info out to everybody, and really to questions on this, come to me. If you're going to sell a property or you're going to buy a property, go to Coco. That's how we make good decisions. If you don't know things, ask people who know what they're doing, and then we can make sure you get good results, because it's a little complicated. We have good things coming in the future, but talk to us, stay in touch, and we'll give you good advice.
Thank you so much for sharing with us, Mr. Michael Lee. And thank you to all the viewers for joining us today and also participating. We sure learned a lot about Proposition 19, and I think I'm going to invite Michael back in the new year for any new updates. So everyone come back next week for Festive of Flavors. We will now end our recording, but please feel free to stay to chat or network. If you still have questions for Michael or for me, that's very specific for your question, very specific to your situation, this would be a perfect time to ask. So I will remain available. Good night, everyone.
Take care all.
Again. If you want to stay around a little bit, that's good. That was very good information, Michael.
Oh, good. I hope it was helpful for everybody. There's a lot kind of changing, but there's good stuff. I think, good things for, older Californians to think about, our parents and aunts and uncles, because a lot of people, I've had that, a lot of people say, this house is too big for, grandma, grandpa, mom, and dad. But, we can't sell it. We can't, do anything because, we're going to get reassessed. Well, that's fixed now. That's good. But, the adjustment of 19 got a little bit weird. A couple of questions, maybe I could jump out, just a couple of things. Let's see. Parents pass away in 2020, but after probate process, the parents' house is passed to the children in 2000. This is a complicated one of what happens here. If you're in an active probate, on this one, I would generally take the argument that the transfer date was the date of passing, not the date of the distribution. But that's somewhat of an open question. That would be something to email me on. Let's see. If recorded a transfer on death, can you still set up a trust? Oh, yes. If you set up a TOD, you can still set up a trust, and you can later terminate the TOD with a trust transfer deed or a revocation deed, the trust transfer deed. Let's see. If current primary home purchase was high, let's see. Oh, this is basically, can I purchase a cheaper home and then use that as the Prop 19 and then try to move back to the higher price home? Generally, I expect regulations to try to put the kibosh on that. Maybe there will be something that becomes a technique for this, but I think that's going to be quite hard to do. Let's see, if a property is in an irrevocable trust prior to February, does it benefit from the old rules? This one's complicated. So if you have a property that's placed in an irrevocable trust and the children are present, the children are qualifying beneficiaries under the Prop 58 system, yes, you could likely put it into the trust, but delay actually giving them the property or the money until the future, and still keep the low property tax basis for long into the future. You could likely do that. The only problem with this is that for irrevocable trusts, generally the understanding is for an irrevocable trust, you have what's called carryover basis. You may have a lot of capital gains tax that's set up there. So that could be an issue. So there's one last question about estate planning, is that you're setting up wills or trusts or these things. If you contact me via email, yes, for witnessing wills and trusts, the staff at the office do it. So my legal assistant and co-attorney or another attorney will help witness that. So all of these questions, let's leave it here at 7 p.m. And then please do feel free to send us email or join the WeChat group and we can chat further. So I wish you all the best of health and the best of the end of the year. Christmas and Hanukkah are coming up. Actually, Hanukkah's next week. So blessings all of you and take care.
Thank you so much. Thank you, everyone.
Take care.
I got some private questions, and you can also, I stay around, and you can also email me or call me with additional information. And Michael, I have some people asking you for your charge rate. I will put them in touch with you.
Great. They can just contact us, and it will really depend what it is. So
Okay.
Look forward to hearing from you, and thank you again, Coco. It's been a pleasure, as always, and look forward to meeting with you again.
Thank you so much. Happy New Year.
Happy New Year. Yes, if I don't see you before the New Year, Happy New Year, Merry Christmas, take care.
Exactly.
Bye-bye.
Happy holidays. Thank you.